Hello, and welcome to this week's Signature FD investment webcast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD, and we'll spend the next 5 minutes or so walking through the latest economic trends, corporate earnings, and strategic insights that are shaping the market. So let's go ahead and dive right in. And we'll just start with returns so far this year. So this chart here shows returns through last Friday for major asset class benchmarks. Now, U.S. large caps had a tough week last week, but they do remain up about 2.4% on the year. Small caps have struggled this year, but what really stands out is that international markets, developed international and emerging markets, are up fairly strongly so far this year. Developed international stocks are up 8.2%, and emerging markets are up 6.9%. Also, commodities are up a strong 8.8%. And that's something to watch as the year goes on here as a potential inflation risk. And then another potential inflation catalyst is the US dollar, which is down 1.7% on the year. So let's turn to a few other macro trends. Last week, we did see some mixed signals coming from the economic landscape. First off, confidence metrics were mixed, with some showing a bit of a setback. So here we're showing home builder confidence and the New York and Philly Fed expectations indexes. And if you look at home builder confidence, you can see that it took a hit. And the New York and the Philly regional purchasing managers indices, they pointed to weak future expectations. So these regional reports suggest that business activity might slow down as we move forward. And importantly, and we're not showing it on this chart, but importantly, prices firmed, showing some lingering inflation pressure. However, there was a bright spot in CEO confidence last week, which did improve, providing a counterbalance to some of these more cautious sentiment signals. Now, on the consumer side, things were somewhat troublesome. The Reuters University of Michigan Consumer Sentiment Index dropped below expectations, and it hit its lowest point here since November 2023. And what stood out was that sentiment around future expectations and inflation, which we show both here in this chart, those worsened. But this was particularly noticeable among independents and Democrats. Interestingly, Republican sentiment remained stable, and inflation expectations even dropped a bit. So this highlights the growing political polarization that seems to be influencing how people feel about the economy and inflation. It also raises the question, how much can we really rely on these sentiment surveys when they're becoming more politically skewed? So with that in mind, what we're doing is we're shifting our focus away from the sentiment indicators and towards more concrete, hard data and composite models to get a more clear picture of the economy. So in terms of inflation, while there has been some pressure building, it's still not too alarming just yet. And overall, the backdrop for the economy remains fairly solid. Now, we are seeing some signs of potential easing in the rate of growth, and that's largely due to real wages slowly tapering off. And that could lead to more tempered economic expansion, but expansion nonetheless. So looking at corporate profits, we have seen a solid growth story unfolding here, with profits expanding by about 17% at the S&P 500 index level so far this year. And that's with 84% of the market cap reporting. Expectations for this year ahead are also positive, with double-digit growth anticipated. So this is an encouraging sign for employment and overall market health. But as always, there are things that we need to keep an eye on. On Friday this week, we're going to get the personal income and outlays report. And that'll be one that we'll watch closely, as it could offer further insights into spending patterns and inflation trends. So let's talk a little bit about market strategy. One thing that we're noting is the divergence between large cap growth stocks, particularly those in the US, and the rest of the global market. So a good example of this is the so-called Magnificent Seven, and that's the 7 large tech companies that have been driving market gains in recent years. Even though they've been on a tear, they're actually down about 1.5% year to date. Now compare that to the aforementioned international stocks, which are up about 7.2% on the year. And that's a shift that's worth paying attention to. So our current strategy has been to overweight US stocks relative to a global portfolio, largely due to that US equity bias favoring those large cap stocks. But if we do decide to trim some equity exposure, one area we may consider adjusting is those US focused funds. Reducing exposure to the large growth heavy stocks could be one way to manage some risk this year, especially if those divergences continue. So, to wrap things up, while we're seeing some softness in sentiment and regional business activity, the broader economy remains stable, with strong corporate earnings continuing to provide a solid foundation. However, we're watching closely for signs of inflationary pressures and shifts in consumer behavior that match the latest sentiment polls. And particularly, we're going to want to watch on Friday the latest income and outlay data. As always, keeping a diversified and adaptable strategy is going to be the key as we navigate the year ahead. And that's especially true here as 2025. When we look back at 2024, being diversified didn't really pay off, but we anticipate that a more diversified approach will end up paying off in 2025. So that's all for this week's update. Thanks for tuning in and be sure to check back next week for more insights. And until then, we wish you a great week ahead.